So up to this point in the semester, we've been talking about how to prevent and detect fraud, some generalities about internal controls, some investigation methods, and now we're going to talk about some specific kinds of fraud. All right, and we're going to start out with the most expensive of all, financial statement fraud. So financial statement fraud is when the management of the organization has intentionally misrepresented the financial reports of the company. They've claimed they have too much net income. They say they have more assets than they do. So the financial statements are misstated. Okay, that's financial fraud, and it's intentional. I mean, this could happen accidentally. That's not fraud. All right. So intentional misstatements of the financial statements. It's done by the organization's management, and it's a huge problem because eventually it's found out, right? And so it's huge losses for investments. Frequently the companies end up going under anyway. What they were trying to prevent happens only worse. And it creates a lot of lack of trust. In recent years, there have been some pretty famous cases people have heard about. Certainly Enron and WorldCom were a long time ago for you, but certainly I remember those big ones. But it still continues to go on even today. So sometimes they call it cooking the books. Sometimes there are inappropriate executive loans. You know, the executives of the organization are stealing money from the place. That's one. There's a lot of things going on with misstated financial statements. Sometimes it's the executives are stealing from the company. Sometimes there's insider trading. Sometimes there has been some favoritism where initial public offerings, right? That first initial offering of the stock is given to certain people and not others. There's certainly been some excessive CEO retirement perks. People leave with millions and millions of dollars. There's been people who've worked for less than a year that leave with millions and millions of dollars. Certainly high compensation, stock options. Backdating stock options was a big scandal a few years back. So there's been just a lot of financial statement fraud, and a lot of it has been for the benefit of the executives, although some of it was kind of what I would call altruistic. They were just trying to keep the company afloat, so they were lying about stuff. So let's take a look at our fraud triangle. So we've talked about this already. We talked about it more in the context of organizational frauds where employees are stealing, what would cause an honest person to do something. But it happens at organizations in terms of financial statement fraud, just like for the guy in the warehouse stealing some of the inventory. All right, it's the same idea. There's a perceived pressure. Now, a lot of times this pressure is we need to get the stock price high, or we need to meet Wall Street earnings expectations, something like that. There's a pressure. It seems sort of almost for the good of the company sometimes, right? It's like, well, if we don't fudge the financial statements a little bit, the bank's going to call in our loan, we'll have to be bankrupt, so we're going to just mess with the financial statements, right? So there's this pressure to look better, typically for financial statements are for outsiders, right? So you're trying to look better to outsiders and make the company look stronger than it really is. And sometimes it really is supposedly altruistic, right? So there's this pressure. We got to have better stock price. We got to have better ratios. We got to have higher net income. We got to have higher revenues, right? We got to look better. That's the perceived pressure typically. We got to look better. A perceived opportunity, right? So there's no controls that will prevent the CEO or CFO or controller from telling somebody, hey, do this transaction, right? Recalculate this depreciation this way, capitalize those expenses, right? So they're the boss. It's kind of like there's this opportunity for management override. Even if the controls exist, where you can tell the CEO no, right? So there's this perceived opportunity that exists, and it's typically the people who want to commit the financial statement fraud. They're in charge of the financial statements. That's the opportunity. and the ability to rationalize. So again, there's this idea of, well, I'm doing it for the good of the company, I'm doing it so our stock price will be higher and everybody will be happy. And frequently it's also that CEO or CFO, because they get their bonus because the stock price is higher, or the revenues are higher, or the net income's higher. So it's not just altruistic. I don't want to make it seem like that, but sometimes it is, and that's how they very frequently rationalize it. Well, if we don't, we're going to go bankrupt. Everybody will have to get fired, right? So there's the same idea with financial statement fraud as there is for just the simplest tellers taking something from the till. Now, we have learned some stuff. Back in 2000, 2001, prior to Sarbanes-Oxley, we had this perfect storm of fraud elements. All right, so back in 2001, right around 9/11, things were already starting to come apart. Then 9/11 occurred, and just everything just really crashed. So it was pretty crazy. So what happened was there was a lot of fraud going on out there. We had a booming economy, so companies were trying to keep up with each other. Well, if they're booming, how come we're not booming? We need to look like we're booming, right? And if the economy was booming and it was raising everybody up, well, it was easier to cover up your fraud, because like if you move some revenues to this quarter, well, next quarter you were going to make more revenues because the economy was good. So it was very easy. Decay of moral values. Business schools did not teach a lot of ethics. I have to tell you the truth. People didn't care that much. Misplaced incentives. There were a lot of CEOs, CFOs, the executives who are in charge of the financial statements were getting bonuses and stock options based on financial performance according to the financial statements. So of course they had incentive to get their incentives by cheating on the financial statements. Analyst expectations. So this idea that out there and there are analysts analyzing the stocks and telling people buy this stock, sell that stock. Well, they have create this expectation that this particular company is going to have this size revenue, this much earnings per share. And if you can't meet that earnings per share, that looks bad, right? So these analysts are setting expectations, and the companies are trying to meet the expectations or exceed them. High debt levels. So when you have high debt levels, you also are going to have a lot of loan covenants. And loan covenants govern things like how much dividends you can pay, how much cash you have to keep on hand, all kinds of ratios. You can't exceed certain ratios. So when these covenants exist, there's a lot of incentive to make sure your financial statements meet the covenants, right? The more debt you have, the more covenants, the more you need to make sure you're meeting those covenants. Focus on rules rather than principles. This is an accounting take. So you have U.S. GAAP, right? There used to be, we've changed this somewhat. We're now slightly more principles based, not entirely. But if there's a bright line for something, like the difference between an operating lease and a capital lease is this number, well, it's easy to make sure you get to that number somehow by manipulating the financial statement. So focusing on rules rather than just principles. It's like, hey, if you are going to mostly use up that asset, even though you're leasing it, it's basically your asset, and you have the liability for that too. Right, rather than the principal. So there's a hardline number, you can fudge around that number. Auditors weren't as independent. You could use the same auditor for decades. Well, you still can, but the audit committees weren't necessarily independent, and the audit committee is what keeps auditors independent. Greed, people were greedy, and of course educator failures. The folks teaching the College of Businesses weren't doing as well at teaching ethics as they do now. All right, so there was a lot of elements of perfect storm back in 2000, and there was a lot of fraud, and a lot of the famous fraud cases came out of this time. So financial statement fraud, what is that? Well, like any fraud, it involves intentional deceit, right? So there can be errors in financial statements. It happens all the time, right? Error is not fraud. right? So it's intentional deceit and concealment going on. So you say your revenues are this much when really they were only this much. You say you have these many assets when really you only have these many assets, right? You're tending to want to make your financial statements look better than they are, and you're doing something intentionally deceitful, making up fake revenues, making up fake assets, things like that. Intentionally misclassifying things, right? So you're doing something intentional. Fraud symptoms or red flags are usually observed, but remember, there can be errors. So just because there's some kind of red flag doesn't mean somebody's committed fraud. All right, you have to go and say, wow, this was an error. It's very difficult to convict these people because it's their job to prepare the financial statements. It's their job to make the company look its best. So some of the stuff that they're manipulating are estimates anyway. Think about things like depreciation, allowances. Those are all estimates, right? So who's to say they did that estimate wrong on purpose? It was an estimate to begin with, right? So it's very difficult. So you have to be careful and to catch these people, right? The financial fraud statistics, before the big bust in 2001, average fraud's about 2 years. Most people used improper revenue recognition, overstatement of assets, and understatement of expenses, right? You're trying to make your financial statements look better. So we have more revenues, we have less expenses, or we have more assets. So that's all positive things they're doing to the financial statements. The average was 25 million. All right. So that's a lot. That's why financial statement fraud is such an important thing to understand, because they get really big. CEOs did most of it, right? The CEO is the main person who has control over the company. So when they're the ones who are perpetrating the fraud most of the time. Very large companies. Remember, this is in 87, 97, right? So we're talking a long time ago, 30 years ago. Some of these, and so that was 532 million back then. It was huge. That'd be quite a few billions today. There were consequences. Firms had no audit committees. That just wasn't a thing 30 years ago. Boards were like insiders, people who ran the company, and some companies were experiencing net losses. Just over 25% changed auditors during the fraud period. So the auditors get changed so they can kind of try to get away with things. Okay. Then 98 through 2007 comes along. More frauds. Average fraud increased to approximately 400 million. 400 million, right? Assets increased. CFO and CEO were nearly 90%. Some of these were actually indicted. Improper revenue recognition continues to be a popular form of fraud. And again, they may make it up. Some did. Health South just made up revenues, didn't even exist. But a lot of them were moving revenues from different periods. Were taking revenues that they would get in the future and bringing them forward using some weird accounting techniques. Boards were still not very independent, so the boards that have independent directors, independent audit committees, those have less fraud because those people are watching, right? Which when you have this close circle of friends that are running the company, these gray directors, these insider directors, they are not watching. They're letting the CEO and CFO get away with this stuff. Many of these firms changed auditors, and press coverage changed stock prices, right? So it all came around eventually. Now, in these fraud cases, these are we're talking about public companies that are committing financial statement fraud. So when you have a public company, they're being audited by a public accounting firm, right? And these are all big public accounting firms that are auditing these big. If that's a company that's creating a 25 million or larger $400 million fraud, that's a big corporation. They're being audited by the big accounting firms. Where are the auditors, right? Well, in these cases, the auditors are failing to collect evidence, right? This is through 2010. They're not using due professional care. In other words, they're not doing their job right. That's what due professional care means. In 60%, they lacked professional skepticism, which we'll talk about in a minute. Professional skepticism is something auditors should be displaying on an audit. In 54%, the auditor failed to obtain adequate evidence related to management representations, which management said, here's our financial statements. These are fairly presented. And the auditors didn't follow up with management. 47%, half of these fraud cases, the auditors got wrong. They said they were fairly presented when they were not. So I want to talk about this concept of professional skepticism, because auditors they're supposed to be catching fraud if it's material. So when auditors come and audit a company, they're looking to see if those financial statements are fairly presented or not. So when we talk about financial statement fraud, the auditors should be catching the financial statement fraud if it's material. Now, $25 million fraud at, fraud is always going to be material, right? But if they're trying to catch errors, they might not catch it, and they might not catch the fraud, right? So those are material. But if you're not exhibiting this professional mindset of professional skepticism, you're not going to be catching frauds. So let's talk about what an auditor should be doing. So basically, an auditor is constantly questioning until they find out the right answer, right? It's not that they they're not assuming fraud is occurring, but they're also not assuming it's not. They're just trying to find out, are these financial statements fairly presented? And they keep asking and they keep questioning until they know. All right? That was the problem. They didn't keep questioning until they knew. All right? They suspend judgment. They're just looking for evidence, right? So they get enough evidence to know the financial statements are fairly presented or not. They continue to search for knowledge. They make sure they recognize motives can lead biased information, right? So if your income depends on the financial statements being presented a certain way and looking a certain way, then you're going to have a reason to misstate them. So as auditors, you need to look for reasons to misstate and find out, and then keep asking and keep questioning. It's just about keeping questioning till you know. That's all professional skepticism means. You keep questioning until you know the answer. You don't just take someone's word for it. So you have autonomy. You're going to decide for yourself rather than accepting management statements. Management says these financial statements are fairly presented. Revenues are this much. Now you as the auditor say, well, how do I know that? Well, I need to go find out. I need to go research that. And I need to resist persuasion. So financial statement fraud occurs. Auditors are supposed to catch it, but they didn't always catch it, especially back there in the early 2000s. And it was a big problem. And auditors weren't using enough professional skepticism. So that's why we talk about it a lot more. In your audit class, you'll hear about professional skepticism. It'll be on the CPA exam if you become a CPA. So professional skepticism is important. So we're going to move on and talk more about financial statement fraud in the next video.